Now, we are going to talk about what's happening in the economy and how we can better position ourselves. How many of you would be interested in how to circumvent what's going on in the economy, how to better prepare yourself so that you can make better decisions? If that on October 26th, last Wednesday, the Bank of Canada increased the bank rate by another 50 basis points. Now, fast forward till today, this family decides they need to renew. Remember, they're coming from a 2.69% environment. Okay, that's where they're coming from. Now, their interest rate is at what? 4.59%. Second part. You know what the real impact is? If the mortgage rate stayed the same, so around 2.69, you know what their mortgage payment would have been? $3,109 versus that $3,796. That's a $687 difference. We're going to talk about what's happening in the economy and how we can better position ourselves. How many of you would be interested in how to circumvent what's going on in the economy, how to better prepare yourself so that you can make better decisions? If that's you, you're in the right place. You are in the right place. So I'm going to jump right into it because we have a lot of content to cover, a lot of material. And so let me share my screen and we're just going to go right into it. All right. Let's see what we can do. Now, I want to talk about a couple of things before I get into our topic today. And one is what's happening in the economy. You see, they did a survey, they did a poll, CNBC, and it said 54% of adults say they have stopped or reduced their retirement savings or contributions due to inflation. What does that mean? They stopped their retirement savings. It means as the inflation is rising, as the cost of goods is getting better, as the bag of rice is getting more expensive, the bread, the flour, the daycare, the mortgage payments, the rent payments, the car payments, the clothes, everything's getting more expensive. What have Canadians figured out they should stop doing? They figured out the best thing to stop is their retirement. Let's focus on now. So we forget about the future so we can deal with now. This is the mindset, right? So they've put out the future on pause so that they can focus. 54%, over half. You put 10 people in a room, 5 out of them have stopped or reduced their retirement savings. And this is a real thing, right? This is a real thing. This is happening. This is happening. Now, the study went on a little bit more, and it said in addition to those 54% that cut back on putting money in their nest egg, 43% of them have already dipped into their retirement savings. And they're blaming the high inflation for these challenges, right? They're blaming the high inflation that, hey, the reason that I have to go into my nest egg, the reason that I have to reduce my RSP savings, or the reason I have to take money from my RSP, because the eggs are too expensive. The gas is too expensive. The butter is too expensive, right? Everything is going up and it's putting so much pressure on the middle income and the lower income families. They're feeling it now more than ever. In fact, some people are resorting to going back to school, getting the OSAP loan so that they can bridge the gap. It's getting that bad. It's getting that bad. And it's one of these things. Well, what should the families do, right? They're feeling the pinch. They're not earning enough. They're not sure what to do about it. They're concerned. They're worried. But nothing happens. Nothing changes from day to day. Sandrine said, for those who have retirement savings. Exactly. Many don't. Many don't even have the retirement savings. They just surveyed the ones that had the retirement savings. And as bad as inflation is, on October 26th, last Wednesday, the Bank of Canada increased the bank rate by another 50 basis points. By another 50 basis points, right? So it's not getting better. It's not as bad as it is and as bad as it was. The Bank of Canada still deems it necessary to increase the interest rate to try and curb this inflation, what they call quantitative tightening, right? Quantitative tightening is when they want to reel the money back in. Quantitative easing is when they want to put the money in the economy. So during COVID, you saw the government doing a lot of printing of money, right? They did that with the CERB. They did that with, different handouts that they were giving, different, incentives the government was giving for people that weren't able to work or, the businesses that weren't able to operate. They were printing money and giving money out. That's called quantitative easing, right? When they want the money back, when they want to reel the money back in, they call it quantitative tightening. And I'm going to show you a little bit of how they bring the money back, right? How the banks bring the money back in. You're going to see that today. You're going to see that today. So another survey by BNN Bloomberg, more than half of Canadians, mortgage holders, worry about payments at renewal. Why are they worried about the payments at renewal? Why is this something that they worry about? It's because as the interest rates go up, as the interest rates rise, if you're a mortgage holder, especially if you had a variable mortgage, you're coming from a low interest environment, and you're going to renew to a higher rate environment, you're going to feel something. You're going to feel something. What are you going to feel? Let's take a look at this. All right, let's dive into it. Historically speaking, interest rates have been fairly low, right? Since 2012, they've been fairly consistently low, and people have taken advantage of these low mortgage rates. All right. Now, 5 years ago, the 5-year fixed mortgage would be around 2.69%, right? If you bought a house 5 years ago, you would be paying around 2.69%. Yes, there was mortgages cheaper, but let's go with what the discounted rate was at the time. So this time 5 years ago, let's say a family purchased a house, they would have paid or they would be paying their mortgage interest rate at 2.69%. Okay. Now, you fast forward to today, you go to Finevo Lending Group, for example, their posted rates, discounted rates, is for the same mortgage. The is now 4.59, right? So if you compare that to 5 years ago, which was 2.69, you see there's a 1.8% increase. Okay, 1.8% increase. You might say, Jermaine, well, 1.8%. What's the big deal? What's the big deal? Let's look and see what some of the concerns might be, okay? Let's take the average family and see what would happen. And I'm going to run a scenario for you, and let's see what would happen. So let's say the average person bought a home in 2017 for $1 million. Okay, 2017, purchased a home, $1 million, and they got a mortgage that was a 5-year fixed at 2.69%. That's the posted rate that you saw. All right. This family did everything they could not to go into any debt. So in terms of, they didn't get any home equity line of credits, they didn't get any second mortgages or anything, just a clean one mortgage. They purchased the house for $1 million. In order to do that, they would need to put down a 20% down payment. All right. So that's $200,000 they would need to put down. That means they would be mortgaged for $800,000. All right. So their mortgage is $800,000. Let's say they amortize that over 25 years at the 2.69%. Their mortgage payment is going to be $3,660. Okay. Their mortgage payment is going to be just over $3,600 every single month. Not bad, right? $800,000 mortgage, not bad. So they've been doing that for 5 years. Let's say they did that up to today. So what does that look like? After 5 years, they would have paid over $200,000 to the bank. Okay. $219,000 would have been paid into the bank. So out of that, there's principal, there's interest. So $120,000 goes towards the principal. That's bringing down the mortgage payment, right? And then the interest payment, $99,000, is fattening up the bank, right? That's the bank's profit. That's how the bank makes money. The bank is in business of lending money. Get this straight. All right, get this in your head. Don't think of the bank as anything other than a business. The bank is like a McDonald's. The bank is like a Tesla. The bank is like a hotel. The bank is like a restaurant. It's like any other business. What is the bank in the business of? Money, lending money, right? That's what they're in the business of. McDonald's is in the business of selling burgers. Tim Hortons is in the business of selling coffee and donuts. The bank is in the business of selling money, means lending money. So they lend money. So their interest that they would have gotten over the course of the 5 years on this 2.69% mortgage is $99,000, right? That's their profit. So the homeowner, this lovely family, is now with the balance of their mortgage, $679,000. Again, assuming they didn't take any second line of credit or second mortgage or home equity line of credit or anything of the sort. So the mortgage is clean, single mortgage, $679,000 remaining to pay off. By the way, how many people are going over the course of their 5 years without getting a home equity line of credit or a secured line of credit or something of the sort? Not many people, right? Not many people. A lot of families, what they do, they try to get money out of the house. They start doing the wraparound driveway. They start doing the concrete. They start putting in the swimming pool. They start replacing the roof. They start doing all of landscaping, replacing the driveway. All of these things they start doing. And what it does is it makes the balance never go down. It's like using the house as an ATM machine, right? You just keep pulling out the equity out of the house. Now, fast forward till today. This family decides they need to renew. Remember, they're coming from a 2.69% environment. Okay? That's where they're coming from. Now, their interest rate is at what? 4.59%. Yes or yes? Okay? So this family renews their mortgage, their $679,000 mortgage. They decide, let's renew it. 25-year amortization. The bank says the best that I can do for you is I can give you 4.59. I can't do any better than that. That's the best I can give to you. So the family does up the paper, and now they're paying $3,700. So just shy of $3,800. So their mortgage payment went up, right? Their mortgage payment went up. And let's say they say, no problem, I'll do it. I'll do it for the course of the next 5 years. So now we're going to fast forward to 2027. What is the picture going to look like? So they would have paid $227,000. All right? They would have paid $227,000. Their principal payment, so out of that 227, 82,000 of that is going to pay for the house. Let's go back for a second. In their first scenario, how much money went to the principal? 120,000. Remember, in the low interest environment, 120,000 went to what? The principal. Now, how much is going to the principal? In the high interest environment, $82,000. You see what's starting to happen here? Okay. And how much goes to interest? $145,000 is going to whose pockets? The bank's pockets, right? This is the bank's profit. All right. So now, instead of before, they were putting $99,000 towards the bank. Now, $145,000 goes towards the bank. And their interest, their remaining balance on their mortgage in 2027 would be $597,000. And on top of that, their payment went up $130 every single month, right? Assuming, again, they have no other credit, no other loans on the house, no other liens, no other line of credits or anything like that. So their payment goes up $130. You look at me and you say, Jermaine, it's $130. What's the big whoop? That's not the way to look at it. Let's calculate a few things. Let's shift our perspective a little bit. Let's see what the real impact is. All right? The real impact is not that $130. It's not even what they paid in interest in the second part. You know what the real impact is? If the mortgage rate stayed the same, so around 2.69, you know what their mortgage payment would have been? $3,109 versus that $3,796. That's a $687 difference. As you pay your mortgage, correct? When you pay your mortgage every month, what's supposed to happen to the balance of the mortgage? It's supposed to reduce. As the balance of the mortgage reduces, also the amount of money that you pay every month towards the bank also reduces. But in this case, it went up. In this case, it went up by $687. Right? It went up by $687. This is the real impact. You know what else? The total paid would have been $186,000. Okay? The total paid would have been $186,000. That's what they would have paid, the total amount. But you know what they paid instead? $227,000 I just showed you. That extra money came out of what? The family's pocket. Remember I told you quantitative easing is when they print money, they give money out, and quantitative tightening is when they bring the money back. The way they bring the money back is by increasing the interest rates. So they reel the money back into the banking system. This family doesn't have a shot, right? Who's in control here, the bank or the family? Many people think they own a home. They don't own a home. They own a mortgage. Many people are under the false pretense that they own a home. They do not own a home. They own a mortgage. Okay? So the principal paid would have been $102,000. That's what the versus $227,000. Right? So instead of paying $227,000 to bring their mortgage down, towards the principal, only $122 went. So they paid more money. Are you understanding this? They paid more money to the bank, but less money went towards the principal of the house. More money went towards the interest. And they actually paid more money to the bank. They paid $41,000 more to the bank. The interest that they paid was $84,000. If the environment stayed the same, they would have paid what? 140 versus $145,000. So a $61,000 difference. They would have paid 84 instead of 145. That's why Albert Einstein said, and I would write this down. I know you heard it a million times, especially if you've heard me speak. You've heard it before, but I want you to write it down. Albert Einstein said, those that understand interest earn it. Those that don't understand it pay it. So right now, who is understanding the interest rate versus who's paying it? This family or the bank? Right? Now you get the picture. The bank is in control in this situation. The balance, look at the balance. The balance of the mortgage would have been $577,000 versus $597,000. So in every case, this is not beneficial for that family, that hardworking family, that when they are going to the grocery store already, they're struggling to pick up the milk and the bread and the eggs. You know, they walk into the grocery store, they come out, it's like $100. You can't go into the grocery store and spend less than $100 these days. The minute you go in, if it's a bag of any sort, right? If you're picking up one item, that's different. But if you go in with a bag or coming out with a bag, the bag is $100. It's $100. Make sense? So this family that's already struggling, all of this money that is being reeled back, you know, from the family into the banking economy, who loses and who wins in this situation? Who wins? Who loses? You want me to tell you? The family loses. The family loses.